everybody happy, Jim? We are recording. So, as I say, if you'd like to raise a hand during the session, please do. As usual, we'll have a hard stop at 11:30. The video will be up later today. So, Aaron, do you want to introduce yourself and Sid, just in case anybody doesn't know who you are? I'll pass to you and your session, and thanks in advance.
Thank you so much, Steve. Really appreciate this. Very quickly, I used to help manage the World Bank's pension plan. Got into a huge fight with the World Bank because they were telling the world to privatize Social Security and moving people from DB pensions to DC pensions. I thought it was a disaster waiting to happen. I've now been fighting that fight for close to 30 years. And along the way, one of the challenges of DC is what constitutes the ideal sort of product design. I think you've heard me speak about selfies, but then the bigger question is how do we customize strategies for individuals? And it just struck me at one point in talking to Sid that he had developed a technique that actually allows us to quantify people's risk preferences. And we just thought it would be a fun project to try to get, I've been traveling, as Steve was joking earlier, I've been traveling, I think, to 11 countries last year. And you see the repetition of a lot of nonsense US products around the world. And so then the question was, are these justified? And that led to this risk preference survey that we ran. Steve, thank you so much for sharing it with people. If you haven't taken it, we'd welcome your input. It's completely anonymous, it's completely voluntary, and hopefully by the end of this presentation, you'll see what we were trying to do. I'll turn it over to Sid because the first part lays down the groundwork for how this all comes together. Sid, unfortunately, happens to be my son, unfortunately for him. And this is normally when he's going to sleep. So, Steve, it wasn't much of an inconvenience for him. But I'll let him describe the technique that we came up with to run the survey, and then I'll talk about the results and what I think it means for countries moving to DC around the world. Again, like Steve said, stop us at any time. It's more fun when it's interactive, and any input, feedback, criticism is much appreciated.
Perfect. Before we get started, can I see any thumbs up if you guys can see our screen of the pension playpen presentation? Okay, perfect. Thank you.
All good.
Awesome. So we'll start with how the industry boxes people and is it justified? So we're seeing in a world moving increasingly to defined contribution, the financial industry makes these broad generalizations to mass market products and advice to consumers and customers. And for me as a 26-year-old, my generation is not going to receive defined benefit at all. So understanding our own investment portfolios, customizing that for our unique circumstances is going to be the utmost priority. I have a lot of friends in med school, and I take advice from them and the point that good treatment follows good diagnosis. And so that kind of prompted and promoted the purpose of this research on understanding the actual individual customer. So what we see in the industry is typically they're sorted into these simple categories, and we find that age is the most common category and box that we're sorted in. And so our question in this research is this empirically validated? The key example that we note is the target date fund, which is prominent here in the US. And this is, the safe harbor default in our retirement system where people are put into investment products based on their age. And as my father will, joke in any presentation he makes is if you back out that age calculation, goes back to the date of conception. So it's a funny way that we get classified in these products. So then we'll move along. And so we'll talk about the methodology that brings us to today's research and what we've built upon. So we started with Kahneman and Tversky's prospect theory in 1979. So actually, when I was in high school, I read Kahneman and Tversky's paper, this groundbreaking paper where essentially these two Israeli psychologists dared to dabble in the field of economics and challenge expected utility theory, saying that people are actually not these consistent rational actors. And they showed this by asking them these simple, contrived, which they called gambles, of making decisions and noticing these interesting behavioral biases and quote unquote flips, which we'll discuss in a bit. And so What I did then was once I took that survey, I actually got the opposite of their survey population. And so then I wondered, am I stupid? Am I crazy? What's wrong with me? And I realized Kahneman Tversky, for all their brilliance, hadn't given to create a individualized, customized analysis of myself and identify my own behavioral biases. So I created a mathematical model behind their original 14 questions, and I put it out to a survey population of almost 400 people in the US. And I found that at the end of the day, these aggregate results that even Kahneman Tversky found, these biases of being more risk averse in gains and risk averse and risk seeking in losses, and this finding of loss aversion, it actually masks individual preferences and differences where I could be completely different from my father and I could be completely different from someone my own age, and someone who fits my demographics. So then our extension of this research this year is that we put this survey out again and to 200 plus global respondents. And the two main extensions is one is the global population. So previously, Kahneman Tversky's was specifically focused on Israeli college students. My research was specifically focused on US-based respondents. And now this one was a global population of teens, adults, and even retirees, whereas my previous research was focused only on investment professionals and then teens. We also then made a change to the format of these questions. So as I'll show in a second, Kahneman Tversky asked these quote unquote contrived gambles as these mathematical choice problems. We had ChatGPT gamify it and make it more fun and make it more interactive, because feedback we'd received on the last time around was that these are too mathematical. It's tough to get through some of the time. So we thought, okay, make it easier if we're making this for a global population. So I will move to the next slide. So just to double click again into the Kahneman Tversky's work, as I mentioned, they basically revolutionized the field of economics, and with their paper showing these behavioral biases and that people act in a inconsistent and irrational, quote unquote, inconsistent and irrational manner at times, essentially created the field of behavioral finance. So let's take a look at an example of some of these questions that they pose. So if you can see here, problem number 3, you can see the outcome here is the choice problem is an 80% chance of 4,000 versus a 100% chance of 3,000. So you can think for yourself, okay, which gamble would I take? Some of you mathematically inclined folks out there might immediately say, oh, hey, this option on the left, the 80% chance of 4,000, actually has a higher expected value than the 100% chance of 3,000, right? It's 3,200 versus 3,000. However, what is Kahneman Tversky found when they put this question out to people is that 80% of respondents actually took this 3,000 option. So they weren't being calculating and saying, oh, I have a higher expected value. They're actually preferring certainty here. Then they did a simple manipulation of this question and changing the framing is they just divided these probabilities by a factor of 4. So from 80%, you go to 20%, and from 100%, you go to 25%. And what they found is their survey population actually flipped. So from that 80% majority picking the 100% chance of 3,000, now you have 65% choosing that $4,000 outcome. And so one thing that they saw is, okay, when these probabilities look very similar, 20% chance versus 25% chance, then people are looking to the outcome and willing to take a bigger gamble. Another interesting finding that they found is when you flip this to losses. So from gains to losses, you see that this 80% chance of 4,000, when that becomes an 80% chance of losing 4,000 versus a 100% chance of losing 3,000, instead of preferring that certainty as they did in gains, they actually took a risk. And they're willing to lose more to avoid that loss. And here you see this 80% chance of 4,000. And so this and other questions caused them to find this thing of loss aversion, where they were saying that people are more affected by a loss than a commensurate gain. That people will risk to avoid taking that loss because it feels so bad. And this is now back in neuroscience and some of these other fields. And as a result, they proposed this utility and this value function where you get this curvature on the gain side because you have this risk-seeking behavior, but then you get this kink on the loss side because of this quote unquote risk-seeking appetite for losses to avoid a loss. So then what I had done in 2017 in my research to extend this, as I said, I had taken the survey, but it didn't seem to tell me anything about myself, is I quantified this. And I said, okay, there has to be a way to take those previous questions and say, okay, if I'm answering this a certain way, this should tell me something about myself. And so for each of those questions, I looked at the outcomes, the probabilities, the relative probabilities, the expected values, and I said, okay, how can I compare questions against each other? And once I've selected through Kahneman and Tversky's 14 questions, get a score that I can take home at the end of the day and say, oh, this is what I am on gains. Am I risk seeking? Am I risk averse? And this is what I am on losses. Am I risk seeking and risk averse? And then as a whole, what is this behavior of mine? And so for each of those questions, you can see that there are different scores for those questions. And so then what I was able to do with that mathematical formula that I created was I was able to take this proposed value function that Kahneman Tversky had theorized and actually done quite well in terms of coming up with the form and figure, had put no numbers to it. It was basically just a guess. And with the results of their population, I was able to quantify this value function and come up with a very similar looking value function. And then you can see as a result, you can be on the scale of, very risk averse to very risk seeking, which results in minus 25 on the risk seeking side, just how this is scored, to plus almost 6 on the risk averse side. So now this recent extension of the research that we're presenting today is, as I said, making this global. And as a result of that, we said, let's make these questions relatable and let's gamify them. So these original Kahneman Tversky questions, as you saw, were very mathematical in the way that they were presented. And so we said, let's create a more interesting solution. And so you can see that the original question of 34% chance of winning 2,400 versus a 33% chance of winning 2,500, again, very numerical, now flips to, you get 2 tickets, a yellow ticket and a blue ticket at a carnival. And the yellow ticket will gives you that 34% chance to win 2,400 versus that blue ticket gives you a 33% chance to win 2,500. Which ticket would you choose? Making this more relatable.
And just quickly, if you haven't taken the survey, take it and you'll get a sense of how these questions, these 14 questions, have been transformed into something that's slightly more relatable. And we even had somebody, because there was one question which we put in the context of should you be buying, I think, insurance, an extended warranty on a car. And coincidentally, one of the respondents had just bought a car and had to make that decision. So their point was it was much more relatable, and that kind of validated this idea of switching from naive quantitative questions to something that people can actually relate to. So then just before we go there, does anybody have any questions on what we were doing with the methodology before we dig into using the methodology? Okay, if that's a no for now, we'll go with it and then we can come back to it later on. Okay.
So as I mentioned, the second part of the extension is making this global. And so here we've, for your benefit, have just showed you what this sample population basically looked like. So the majority of respondents were within the ages of 25 to 65, which was a stark difference in how we presented the last research, where the majority of researchers were actually below the ages of 21. So we're getting a more working age population in this sample. Majority are male, but we still had a solid female respondent base. And then I think we could, the education was also really interesting in this population, is we had a very educated in the sense of degree population, where a majority of our respondents had a master's or PhD. And this is likely, sample bias between our network in where we put the survey out. And finally, in geography, we got a nice evenly matched sample across the world, from North America, in the US and Canada mainly, to the UK, where all of you are based. EU, we had a lot of responses even in South America, mainly coming from Brazil, and then Asia, mainly coming from India.
Just one other category that we decided to look at, because everybody talks about a very polarized world, is we also threw in political leaning, which was, again, this one in financial literacy, people had to self-declare. So we had 5 categories, which was either you're liberal, you're conservative, you could be socially liberal and fiscally conservative, you could be the opposite of that. And then the 5th category was did not identify as one of the 4 or did not want to reveal. And that was, it ends up being interesting. Again, slightly biased to the US, but thanks to Steve and Mona Dole at Net Zero Investor, we got enough UK respondents to make this fun to present here. Okay.
So now, before I hand it off and we discuss the results of what we found, I'll just quickly give you a little bit of a sense of some of these value functions so that you're thinking about these in your mind. So as I showed earlier, the original quantified Kahneman-Tversky value function looked very risk averse on gains, and then you get this risk-seeking behavior on losses. What we found in the survey aggregate of our recent study is that we actually had a more risk-averse nature on these losses. And so you don't see this deeper bend in the loss curve that you do here. The second thing is just to give you the 2 extremes. So again, that you can be thinking in your head of what these value functions may look like, is the most risk averse respondent in our population, where this value function essentially looks like a U, because the more risk averse scores are scored higher on the y-axis on the positive side, whereas on the negative side for risk seeking, they're on the lower side, and so you get this more U-shaped on the other way. And that actually looks a little similar to the survey aggregate population, which seems to be more risk-seeking on gains than the original Kahneman-Tversky population, and more risk-averse on these losses, but still relatively risk-seeking. So with that, I will turn it over to Arun for the results.
So we ran this, but we kept the survey open for about 2 months, and then we just decided arbitrarily to close it on December 31st so we could present some results today. But keep, if you enter in your responses into the Google Forms, that'll help us extend this out further as well. Now, here's one very funny result that came, and I promised Steve and Henry that I would say a couple of controversial things. One was when we ran the 14 questions that Kahneman and Tversky had versus, this population, only 43% of the aggregate responses were identical, right? So we're just not able to replicate that original survey, which wins Daniel Kahneman a Nobel Prize, in 2012, I believe, right? And a great example is if you look all the way down at the bottom, the first question, the first gamble in their survey, they claim that 82% of the people picked option B. In our survey, we got 69% picking A, right? So completely flipped. The same thing for 3 prime, which is a loss on the third question. And in some cases, the last one, number 7, even though we got the same response, it wasn't as significant a number like they had claimed they found in their population, right? So this begs the big question, why are we getting such a different result from a Nobel Prize winning paper? And we can only guess, right? One is they chose Israeli students. Ours is a much more heterogeneous population. It's global, probably diverse in terms of experience and education. The other question is, have preferences changed over time? This was in 1979. We're doing this in 2025. Could time have had a difference in how people turned out? And then the last possible explanation, which I think probably is the strongest one, is they found that how you frame the question influences people's outcomes. And we know this because we're manipulated by advertisements all day long. How we framed it using the chat GPT could have influenced how people chose the outcome as well, right? So this is something we're throwing out there. If you have any ideas, we'd love to hear it. We don't have a strong hypothesis. It's just something that popped out from the survey as well. I think Bobby has a question. Bobby, do you want to throw something out?
Yeah, I tried to complete the survey, but I found that I think your framer one is correct because I found I wanted the third option for most of the answers. I couldn't say, I was basically flipping the coin for most of the answers. It wasn't really framed that give me an obvious answer to go with my risk preference.
Correct. And so that's where we were a bit constrained because we went with their original questions in terms of the numbers because we wanted to be able to compare it. So we were a little bit stuck and we didn't like the original questions, but for the purpose of the survey, so that we could then, collate it to that one, we stuck with their numbers and it wasn't always obvious. So that's great. Thank you for that. Sorry, Bob, you got a point as well?
Well, I was going to say, why don't you rerun the question by going back to the survey people who responded, but using the KT methodology, either mathematical basis, see if you get a flipping back to their version.
So in fact, the next iteration is now to give people the choice of doing it one way or the other and then see whether we can catch them. Because interestingly enough, in our survey, we embedded a couple of questions which were identical, but flipped and presented later in the survey to see if there was consistency. And I think both to your point and Bobby's, I think in both those questions where we kind of played it out, only 75% of the survey respondents got the identical answer to both, right? So it can be interesting that maybe even once you get tired, through 13 questions, by the time you get to question number 14, you answer a different way. To Bobby's point, you probably just flip a coin. So there are some issues with the way in which Kahneman and Tversky ran the survey, but it's amazing that it's become the basis of an entire field of study called behavioral finance when it's kind of very flimsy in its own structure, right? So we have some sympathy for what you're saying. But that's what we have, and that's what we figured we'll use that because that is considered the gold standard for sort of behavioral finance, right? But in the future, we're going to try to evolve these questions to be a little bit more interesting and maybe take actual life situations and pose those questions as opposed to, and today maybe with AI, we can discern people's behavior from, clicks that they make on various websites. So yeah, this was a fun one. We weren't expecting it wasn't part of our research, but we decided just to throw it out there for everyone. So now comes the most interesting one, which is you have this, and Steve kind of teed me up to say, hey, don't go after Nest. But Nest has default options that are age-based, right? In America, this is something I fought with a lot of providers because I was on the board of a very large public pension plan. We were defaulting people into these stupid products called target date funds, where, like you say, the rebalancing declines with age, more into bonds and less into stocks. Funny thing is, according to this survey, we can find no significant difference in preferences based on age, right? This is in the aggregate score, this is on losses, and this is on gains. And so products that are designed on the basis that as you age, you should get more risk averse have absolutely no basis in our survey. Okay, so it kind of throws all of this nonsense that's being pushed to us with these life cycle and target date funds out of the window. And what I would argue, and I've published papers on this, and you've heard me go on and on about selfies, is everybody has a target income that they want. The rebalancing should be based on where you are relative to that target income that can be locked in, right? So I think all these products that are out there that have an age basis are complete nonsense. And happy to debate anybody on this. Instead, if we ask people, what is your risk tolerance? What is your target income? Where are we relative to that on your path? That's how you should be rebalancing between risky assets and safe assets as well. So I'm glad this came out the way it did. We just can't find any difference across these various buckets. Okay. Anybody have a question or a comment on that? Okay, go ahead, Bob. Yeah.
Yeah, Aaron, just really way back early 90s, I was setting up in the UK a number of DC schemes because what was going on with DB and the legislation in the UK. And the lifestyling was coming about. The move to move assets into gilts was not because it was a safer investment. It was to enable people with DC funds to have more certainty of the annuity that could be bought with an insurance company. That was the only reason. Unfortunately, the early designs which were set up were picked up by a lot of insurance companies, and you end up with what we've now got, which is products which are totally irrelevant. So I do agree with you, Aaron, that the way scheme design has gone doesn't actually reflect the needs of individuals. So it's just interesting that, absolutely, that people need to understand why these things were set up in the first place. It then gets marketed by insurance companies or investment managers as a particular feature when it's totally irrelevant to what actually the end need actually is.
In fact, you hit the nail on the head, Bob, because I had called up the people at BlackRock, who were the vendor for the Virginia retirement systems on which I was on the advisory committee. And I said, does your product guarantee anything, right? Can it guarantee your wealth number? Can it guarantee your income number? And they said, no, it doesn't guarantee anything, right? So they actually admitted it. But they've got 3 trillion of assets in those products. So they have no incentive to change it. And in America, the stupid government has actually given them safe harbor, which means I cannot sue them if I get a terrible outcome, right? So we've created this incredible industry, to your point,
It's a
which is
monster.
not about giving people what they need. It's about
Right.
how the hell do I make a massive profit, and this is more dangerous as we go more into DC, right? Chris, I think you had a point as well.
Yes, thanks, Aaron. I just wanted to back up Bob's comment. I mean, essentially, yes, lifestyling did make some sense pre-pension freedom, so pre-2015. But subsequently, we really should have addressed the issue that gilts had to be looked at on their own merits relative to equities. And we just didn't do that. That's right across the ecosystem. I mean, the problem with DB and everything, that the whole system of continuing to invest in overvalued gilts for the whole of the last decade has created what I call the decade of delusion.
Yeah, and this is, I think, where sadly, if you had the dashboard in the UK and this whole benchmarking to retirement income, I think you're going to get better product design. And absent something that informs people on where they are in this retirement income journey, allows these ridiculous products to be marketed, right? In fact, the Indian regulator, who at some point I hope you guys can get on Pension Playpen, is really forcing this idea that we have to anchor everything on retirement income, and age is not the metric by which you do that, right? So hopefully we'll be successful by throwing this result out there. But this, again, to us, we didn't know what to expect. Sid's earlier research had shown that there is a difference between teens and professionals, because there is this hormonal sort of jolt that kids get. They tend to be very risk-seeking, but we don't see it in the working population. And to us, this is actually quite an interesting result. Okay.
Yes, just on that,
so-
I mean, the teens, essentially, they live on their phones and they live on what's the latest price move, what's the asset value. They don't, to get them to focus on income 40 years in the future, it just won't work, will it?
Yeah, exactly. And so that's the interesting question that this raises, is how do we start to get them involved early on? Because like Sid said, he's not going to have any defined benefit, including Social Security, right? So he's got a real problem, and he's got to figure out how to solve that for himself, because the industry is definitely not doing it for him. So yeah, that was the age one. The next one was gender, which is an interesting one, because we see a lot of discussion about are women different from men, etc. And what's funny is, again, Sid found this in his research between professional men and women in America, but we got a slightly different result here, which is in aggregate, they aren't very different. But when we split it up between how they behave on gains and losses, interestingly enough, women show up in our survey as being more risk-seeking on losses. And what does that mean is that if you're trying to market insurance products to women, again, I'm using the aggregate here, and we'll go into details on the individual, then probably women are not your best audience. And this has implications for annuities as well, right? Which is weird, because they have a longer life expectancy. Typically, the historical numbers have shown that women get lower pensions because of discontinuity of service. But we were quite surprised that in our survey, globally, women seem to be more risk-seeking and significantly different from men in that behavior. Okay. Any questions or comments or feedback on that finding? That was a bit unusual to us as well. Okay, so we'll skip that one. Then the other, sorry, I think Padraig has a question or a comment. Go ahead.
Yeah, just on that point about them being more risk-seeking, is it because that they typically, and this still exists today, they're earning less than men, even if they're in the same roles, so that now that they're well established in the work market over the last 60 years, they still have to contend with a pay gap. And so therefore, as they're becoming slightly more financially literate, are they becoming more prepared to take a little bit more risks, simply because they know they're going to have to make up more if they want to have a a retirement income that's similar to a man in the same position as them?
That was our gut feeling, because this goes back to Kahneman and Tversky's finding that we tend to be loss averse, right? That is, we tend to gamble more when it comes to losses. Now, my take on Kahneman and Tversky's paper was I actually thought it was crap. Again, I hate to be that controversial, because the problem is, a gamble of $4,000 for somebody who's extremely rich versus somebody who's extremely poor. And basically, you guys can translate that into funded status, right? If I'm overfunded, then I don't want to gamble my losses, right? If I'm underfunded, then I want to gamble it, because if I can't buy a house or if I can't get to the goal, I may as well gamble, because anyhow I'm not reaching it. Whereas if I'm overfunded as a pension fund, actually immunizing makes a lot of sense, because going underfunded is not a great thing. So I think, Padraig, what you're saying in a slightly different sort of phrasing is women are basically underfunded relative to their target. And the only way they're going to make it is basically trying to gamble their way out of it, which is a terrible thing, because we should fix the fact that they're not getting paid properly instead of forcing them to take riskier gambles, right? That was our bias, but I'm glad you felt that as well, because this is a sort of consistent finding that we find globally as well, right? As women typically have lower retirement incomes than men and live longer, so they've got the double whammy. So this was fun to find out as well. We have to break it down by country, which we haven't done. So this is still the aggregate. And if we get more respondents, it'll be fun. We're going to skip quickly and ignore financial literacy. I'm not a big fan of these financial literacy surveys, and we can talk about that separately. But interestingly enough, education seems to matter, right? And again, here, when we go back to losses, people with high school degree, and we didn't have a large sample. So if you have friends who just have a high school degree that you can share the survey with, it'll help us sort of make sure that this is a more robust result. But Padraig, I think we're seeing the same thing here, as people with a high school degree are probably trying to gamble their way out of bad situations, but we don't see that as education levels increase as well. Okay? Again, I don't know if anybody has any thoughts on that, but we can discuss. Now, here comes the fun one, politics, right? There's a lot of research and, social commentary on how liberals are different from conservatives. And actually, this is the first thing that motivated our research, was to see, are we really that different, right? And funnily enough, between the liberal and conservative label, again, all self-declared, so we didn't have any other way of declaring it or identifying it, we find very little difference, if any. But the funny thing is, the folks that categorize themselves as refusing to respond or different from the other four, so the other four being liberal on social and fiscal issues, conservative on social and fiscal, liberal on fiscal issues, socially conservative, and vice versa. The fifth one refuses to answer. They're actually the most interesting category, because they're very different from everybody else. Okay. And I think it goes back to, saying, hey, first, why don't we all get along, right? Because we're actually not that different in a financial risk preference perspective. But then I think it goes to the more sort of broader comment that we're making, is this idea of mass marketing product to various groups. There's no sort of empirical basis to a lot of these results, and we need to rethink how we're, offering products to people as we go into a DC world. My bias, I've been in fintech for 25 years, is the level of technology today allows for complete customization. So I think we heard from my friend Rogier in the Netherlands that, PGGM is going to put people in an cohort bucket 25 to 30. I think that's completely nonsense, right? So this is, again, I think, reinforcing that a lot of these labels don't mean anything. The last one, which is the most interesting one, is geography, right? And I wanted to be cute because I tease Henry about baseball, and sadly, the final test is not going the way that England wanted, even though it looked like a pretty good start. What we're finding is you folks in the UK seem to be much more risk-seeking than a lot of other people that we find around the globe. Okay, and this was a surprising result to me, because I always, I worked in the UK for a while. I always thought, the British folks are more sort of conservative. Doesn't come out in the survey results. Now, it could be like Bobby said, he was flipping a coin and that's all we caught. But relative to the rest of the world, I think there's a difference here. North America, again, we find completely different segments in North America, Latin America, Asia, and the UK and EU. And it goes back to this point where, I see the UK government looking to Canada or looking to Australia to copy their model. I think what this argues for is you've got to design something for your own country itself, right? And I think this to me was the most interesting finding is these big companies want you to take the target date fund that they designed in America, or most of the academic research in the space is driven by American academics, right? And I think a lot of that is nonsense when you take it across, an ocean or a border. And so I think this was to us the most interesting finding. And hopefully when we get a few more results, we'll dig a little bit deeper into the UK results as well. But, the people in Asia are, again, much more risk-seeking than, most others as well, right? Now, we know that people in India similarly probably have low incomes, and so they probably have to gamble. Interestingly enough, Brazil was more risk-averse on losses than North Americans, and I wouldn't have guessed that again. So if you had asked me my priors, I would have had very different sort of guesses as to where these different countries would have landed based on my travels and the people I know. Survey actually flipped everything I thought on its head. And I'd love to throw it out to see why you think this might be the case. Do you have any thoughts on why the survey results which suggest that the people in the UK are more risk-seeking than some of the others?
Desperation. Peter?
Peter,
Yes,
go ahead.
Sorry. Can you hear me firstly?
Yes.
Yes,
Yeah.
you can. Yeah.
Fine. I just wonder there, in fact, is this perhaps because in the UK, particularly with pensions, we have been taught that DB pensions, those that target an actual pension in retirement, are high risk. Because all the legislation and all the issues are dealing with the risk of DB pensions, and that has sort of imbued itself in the culture. I just wonder.
Bobby, sorry.
Yeah, it comes back to the point we said earlier about guarantees. I think the lack of being able to buy affordable guarantees in the UK, because the reason none of the likes of BlackRock and that can provide guarantees with their DCs is because as soon as you apply a guarantee, it comes in the children's product under completely different legislation with loads of capital requirements. So guarantees are ridiculously expensive in the UK. So there's been, been like 30 odd years since guarantees disappeared as an affordable product in the UK.
I see. Yeah. Yeah, so that's what's fascinating, right? And these questions were asked, literally, we just ripped off the Kahneman and Tversky question from 1979. And we're starting to see that behavior, I think, manifested out here. Con, do you want to go? Sorry, you got a thought? Con, I think you're muted. Sorry.
I think if you want to explain a risk-seeking behavior in the UK, what you actually have to look at is people's other wealth. I think you are quite likely to get a different response from those people who have DC rather than DB. I think you would also get a different response from those people who own their own home versus those who rent their accommodation. That's, I think, why you are getting that difference. If you have a DB scheme already, it's perfectly sensible to go out and gamble on the other. Whereas if you are in DC and you have downside risk there, gambling makes it a very, very risky proposition indeed. And there are similar arguments to be made around home ownership as well.
I think you hit the nail on the head, Con.
My Chelmsford, anyway.
Yeah. No, I think you're spot on, because what I did at one stage with my students at George Washington University, this was probably 10 years ago, was I took the Kahneman and Tversky questions and I teed it up by your starting position is you want to buy a car for $4,000 and here's the gamble, right? To your point, I was trying to set them a baseline of where you are currently. And again, I found that the Kahneman and Tversky responses were either flipped or I could explain it in the context of where they are relative to their natural position. And I think what you're arguing for, which I like a lot, is these financial advisors or these vendors of products need to do a little bit more analysis on who the client is, as opposed to just generically dumping you in a product, right?
Absolutely.
And I think you've nailed it right there. I think we need to get another way of finding out people's individual details and then calibrating it and saying, oh, this explains your behavior right now. So do you want to tell the story of our neighbor, Suzanne?
Yeah. So, interestingly enough, when I started to do this research, I said, okay, let me test out a few of my priors. And so I went over to my neighbor. She at the time was a 75-year-old woman, fully retired, had grandchildren and was financially very well off. And so I had her take the survey, and she turned out to be the most risk-seeking person in my entire survey study. And I was shocked because, it's not something I would have expected. It's not something I think most people would have expected. And so it goes to this point of, focusing on the individual. And one point of contention there could be that her reference point is so high and her funded status is so high that, there's no need to be safe. Like, why, for her, why not? And her husband had passed away. So for her, maybe taking a risk is something that could have satisfied a lifestyle that
Yeah, like you said, Khan, you can gamble when you already
can afford to.
your status guaranteed, right? So you're not going to fall off that cliff. So that's actually a good thing that you have to find out.
Aaron, a jaundiced viewer would say, I'm gambling because I'm only going to have to leave it to the kids.
My brother got a book for Christmas from his kids, which said, how to spend down to zero. And I'm wondering whether his kids are stupid, because you probably don't want your dad to spend everything down. But yeah, I think there is.
I didn't give my father that book.
But this was a fun finding for us. Okay. I think we don't have much more. So big picture, I think we've already sort of hit the nail on the head, which is all these out of the box solutions are garbage, right? I think John has a comment. Sorry, John, let you jump in.
Yeah, so look, thank you for that. I've got quite a few actually. I'll pick it up separately. One, there's nothing wrong with target date funds if they're designed properly. They're actually very efficient, much better than lifestyling, but it's all a question of what you're target dating into. There's so little research on behavioral economics out there. I've probably read, 50, 60 books and papers and more. I think it comes down to, for me, it's come down to something I read a while back called Kydland Law, which is if you write a problem down clearly and specifically, you've solved half of it already. And I think that's part of the challenge is, in general, I would give the industry, both UK and elsewhere, 2 out of 10 for behavioural economics at best. I think it's shocking, and part of the reason why it's shocking is there's no money in it, because a lot of it involves people who haven't got any cash in the first place, relatively speaking. Therefore, the big fee-based earners and organisations find no interest in getting into this. That may well change with the regulator forcing, I suspect, people or trustees to do something. We found there was a lot to do with the theory versus real, that people's answers to questions were theoretical, but their behavior was sometimes different. So it's behavioral versus opinions. There is zero research on anything in retirement. Con and I have spoken about this. There's the interaction with advisors, which makes it incredibly complex. The only decent research I've seen in the last 20 years came from Van Kampen, who were the Morgan Stanley's team that flipped to Invesco Consulting. They did a huge amount of work in the US. There was a gap elsewhere. And I think to question the Kahneman and Tversky, absolutely. It struck me many times this was the equivalent of 5 a day. Someone dreamt up the utility curve. And there's nothing wrong with it, but the utility curve, as far as pensions is concerned, has so many other factors, whether it's interaction with the state, whether it's the pound cost averaging, whether it's the issues to do with what your target is and how close you are, your funding status and so on. It's incredibly challenging to get anything meaningful in this space, is what I found. And I've been looking. The only thing I would say is I bought Mark, what was it, Shlomo Bonazzi's book when it first came out. $67 it cost me, and it said 3 things. People don't like making decisions, don't give them too much choice, and they choose the middle one. That was behavioral finance for me. I spent too much money.
Don't get me started on Shlomo, okay? Because I could go on and, this is the scary part, is they've marketed this.
The biggest thing of all though is the body of questions, and until we get a sufficient number of questions out there with nuances, and that we can compare and contrast and aggregate the findings, we're going to be we're guessing, and there's nothing wrong with guessing when you don't know any better, but we'll never get perfect, because this is mathematically trying to overlay mathematics onto psychology, but it gives us some compass points and direction points.
Yes. I think you hit the nail on the head, because, and Sid would argue this more forcefully than I would, is we have to find a way to look at people's actual behaviors and then discern the biases out of that, right? And today, I think with AI and the availability of people handing out their personal information by clicking on phones, I think it's feasible. Somebody's got to take that next step and say, let's use AI to discern how this works. The other thing that, we've talked about a lot, I had a heart attack 13 years ago, right? I had what's the equivalent of a widowmaker. My risk preference flipped on a dime, right after that. And so it's got to be a longitudinal thing. It can't just be a one-time thing. We take it now and then we put you in a box forever. It's something like your annual checkup that has to be done on a more regular basis.
Yep.
And then, to your point, recalibrate your product rebalancing to that context. The reason I've been arguing for selfies as a basic, quote unquote, safe instrument is that at least allows you to put your money into a guaranteed real return income stream, right? And so I would argue that the creation of target date funds should be based on rotating you into the guaranteed income once you hit your target level at some point. Sure. But the current offering, like you said, is kind of silly, right? It's just meant to aggregate assets and put you in a bucket, and then you bear the risk. And in America, I can't even sue the vendor if they do a terrible job, and have admitted to not doing anything either, right? That's what's amazing. BlackRock can tell me that they don't guarantee anything, and they've got no legal consequence for doing that. Right? That to me is a terrible thing. Right?
I agree. Thank you.
I think it takes us kind of to the last slide, which is, what does this mean for the UK, right? And I think we've already discussed that. I personally think, John, to your point, you got to figure out what your own risk preferences are. I don't think these advisors are capable. I do a lot of training for advisors. I don't think they have the wherewithal to come up with it. In fact, we even had an idea, which was, should we be running like a Match.com where the advisor should have preferences that are aligned with your preferences as well, right? So you don't just go to somebody who has a fancy office at St. James Place, go to somebody who has the same risk preference or the same risk tolerance that you have. So that's one possible variation of this. Again, to your point, how do we keep testing people's preferences? Because the preferences could change with age, but that's because you've had different life experiences, not because you became a year older, right? I think that's, and to Khan's point, if you bought a house or you suddenly now have a DB that's guaranteed, you are vested, your preferences will change as well. I think clearly the default options should change. I think Nest is doing a terrible job of sort of bucketing people and generally throwing them in this investment bucket. I think UK specific products, I think sadly, for some reason, the UK government is looking all over the world to get investments in infrastructure and private assets. And I think there's got to be UK design choice. That's got to be a much better solution, right? So, sorry, John, you had something else as well?
Well, what we found as well was the word guarantee wasn't actually a popular word. People preferred the word security because they didn't believe, the research said they didn't believe the word guarantee in the first place. So it's a fascinating thing. Just that as a framing question is a tough one, because too good to be true. They don't believe anyone's going to pay out, whether it's a government or anyone else. I mean, it's a tough gig.
That's a good point. That's a good one. Yeah. Sorry, Steve, you had a comment as well?
Yeah, I mean, amazing presentation and lots of really exciting, interesting stuff. Two big things I wanted to ask your opinion on, and probably Sid's as well. We've got two things happening in the next year or two or three: pension dashboard and pensions commission. I mean, surely this sort of stuff should be front and center of pensions dashboard, because it's all well and good to sort of click on and say, "Oh, here's my fund and here's my pension," but what does it all mean for me and my age and me and my risk preference? Am I in the right fund? Am I going in the right direction? So why isn't this stuff sort of perhaps, maybe it should be, built in at some point to the pension dashboard? And also the Pensions Commission, quite a few of us on this call, most of us are aware of the Pensions Commission. Surely this has also got to be front and center of real people wanting real good outcomes from their pension investment. Is there anything we can do over here to push that forward, Sid or Aaron?
First one, take the dashboard question. I'll take the second one.
Yeah. Thank you, Steve, for the comments. I think on the dashboard side, it is something easily implementable and something that you can have respondents take. And as my father mentioned, the longitudinal aspect can be important, is being able to track people's preferences over time and show, hey, your preferences are changing, having check-ins and understanding, and then making sure it's aligned with those portfolios, both on what your preferences are, and maybe if your advisor or the robo technology at the time says, hey, maybe you should even reconsider your preference based on your certain characteristics. So I definitely think the space for this in the pensions dashboard.
Yeah, I think, Steve, you hit the nail on the head. And thanks for your efforts to get me more respondents from the UK. But I think somebody should do a much broader survey than what we did, right? I think we didn't get enough and the time window was short. But I think the Pensions Commission should at least ask somebody to get, a few thousand UK respondents, right? And then see what it looks like across these different buckets. To Con's point, we didn't ask about whether people own or rent, right? Whether they have a DB. These are simple enough sort of baseline questions on which you can then run these surveys and say, listen, given everything we've seen, here's how the populations are segmenting themselves out, right? If they're uncovered workers, I think you call them informal workers, maybe, or gig workers today, that could have a completely different impact from, somebody who's got a secure job as well, right? So there are these other demographic variables, and I think your suggestion of, I didn't even think about the Pension Commission, but to me, it would be frightening if the Pension Commission comes up with a set of recommendations without asking what is the population that we're looking to serve, right? And this I find so often in pension design is three people decide, like the OECD had a conference in Turkey in November, and I was obviously the gadfly. But they were just coming up with a generic recommendation telling every country in the world to implement it with no sort of interest of, is Turkey different from Hong Kong or Africa, right? And I think, to your point, I think somebody should tell the UK Commission, let's at least find out what the general population in the UK wants before we decide what the Pension Commission should opine on. I think that's a brilliant comment, Steve. I'm happy to help in any way possible, but I think somebody should bring this point to their attention is let's start with understanding who we're serving, right?
Yeah, I agree. I mean, the hard-hitting point is, we know why the three commissioners have been appointed, but if you look at the average age, 3 times a big number is a big number. So there aren't many people of Sid's age helping the Pensions Commission, and this is all really important because I think one of the pieces that in the press release and in the in the sort of presentation that they gave was, this is sort of got to get it right this time. We can't have another Pensions Commission in 2035 or 2040. We've got to get it right. So why, they need to look at the demographic of the younger people. It's so important, and that's the theme that we should be pushing, I think. So.
Sid, I'm volunteering you.
happy to help in any way, and we're happy to share our research with anyone, who might have thoughts on that. But yeah, thank you for raising those
And
points.
actually, and if you could, if any of you could share the survey with friends that you have that meet some of these other buckets, we'd like to get more women, obviously, to respond. We'd like to get people with just a high school degree, more young people, Steve, to your point. Because again, this was my problem at this global conference on pensions, was everybody was 50 years and above, and there were no people who were 25 to 30 for whom this is going to be incredibly consequential, right? So we need to get young people engaged in this discussion. And we're open to any ideas on however we can help. I'm sure we'd be glad to do that.
Okay, so I've
hope
put
this
a
was
link.
fun. Yeah.
Yeah, I put a link in the chat for your survey. Did you say it's now closed, or can you reopen it now?
No, we can keep it open. We just wanted to close it so that we'd have something tangible to talk about today, right?
Today.
So
That's fine. Okay.
I just needed enough respondents from the UK to make the UK numbers meaningful. And we've got enough to start, but more the merrier, right? I think we can keep updating this if possible.
Yeah, okay. So everybody's benefit, if you look in the chat, there is a link to the survey. It'd be great for you to anonymously complete it. And there is a wide range of ages and demographics on this call. So it'd be really, really, I think we'd be all grateful if you could have a look at it at some point over a cup of coffee or a cup of tea. Excellent. So Aaron and Sid, the next step, I mean, obviously this, we'll try and get that done. Next step for you, what does 2026 look like in this space?
What I'm committed to, right, is I want to see greater adoption of this general idea of selfies, which is how do we make sure people have retirement security through better financial instruments. I think India probably is the next country to do it. Chile has already done a variation of it. To me, it's a shocker that the UK has not done it. The preconditions are all there. You guys have rising debt issuance, you've got a DC problem. Why the debt management office will not create some security that improves retirement security is a challenge to me. So that's on my sort of agenda. Sid?
For us, I think, as you said, Steve, getting this in front of more regulators and making the point very clear that these products that we have offered to us, especially people my age, if any, are not correctly calibrated or intentionally calibrated for the individual. And so focusing more on the individual and their preferences and their needs, I think, is of the utmost priority.
Yeah, and Steve, you can relate to this, but with today's technology, to have the ability to individualize a product or understand somebody's preferences, and I think to Khan's point, people are on their phones. Why not use the phones for something productive, which is find out what people's preferences are and then give them something that caters to their needs, right? So
yeah. Okay, Chris, you got your hand raised, and then we'll bring it to a close. Chris, do you want to unmute?
Yes, thanks, Steve. I thought I'd just make a comment on Aaron, and we've had conversations before about selfies, and I think he knows that I've been doing a variation of the selfie, if you like, in the decumulation space in various forms. But I think the issue really is that the government see accumulation as an equity landscape and has a more open mind on decumulation. But even there, I'm struggling to get traction at government level, although quite interestingly, I'm getting interest at parliamentary level.
Well, we'll take it wherever we can get it, Chris. Happy to help in any way, right?
But I think that's the point. It is it's the fact that they're all about private markets and all sorts of other ways of getting extra asset value. They'll argue about a couple of thousand in your DC pot if you go down private markets, when it's nonsense, isn't it? Quite frankly, if you think about it, if a private insurer or anybody else was doing it, it would carry a big health warning. No guarantee this will work, but you'd think from what the government is saying that it's all about guaranteeing a better outcome, a bigger lump sum when you're 65 or wherever. So that's the problem. I think they're too focused on equity, and that's why.
Chris, my tagline for that, and I'll use that as the last comment I make, is keep your privates out of my DC pension, right?
I'll support you there.
And Aaron, I'm already thinking of the book that Sid could buy you for Christmas about retaining wealth for the kids. So I'll
There
come
you
up with a
go,
good.
Steve. Any recommendations would be
I'll
appreciated.
come up with a good book name for Sid. Yeah, Dad, don't spend it all. There you go.
Thank you.
So
This
good
is
stuff.
my
Excellent.
retirement plan.
Exactly. Yeah, Dad's retirement plan, which is mine.
Exactly.
Excellent. Okay, listen, Sid, Aaron, I know it's really early in Washington. Thanks for dialing in so early and joining us. I think it's been really, really excellent session. I hope everybody will join me in thanking you for clapping and digital clapping and thanking you for your time this morning. If you want to do the survey, it's in the chat, so have a look at the chat and do the survey and help Sid, especially with some more data. And the video of today will be up later on this afternoon on Pension Playpen. Next week, we have an investment update from BlackRock. Woohoo! So there you go. A big gun giving us an investment update. So BlackRock will give us an investment update next week. So I hope you can all join us. Be safe. Try and keep warm in the snow and enjoy the rest of your week. And we'll see you at the next Playpen session. Thanks again, Sid. And thanks again, Aaron.
Take care,
Okay,
everyone. Thank you
take care.
so much, guys.
Cheers.
Take care. Bye-bye.
Yeah,
Bye.
Happy New Year.
Thanks a lot. Happy New Year. Bye.